we'll probably get into some crunching some numbers at this point. So we know what modern portfolio theories is. We know the mathematical backgrounds. We are trying to optimize our expected utility, and we are trying to keep a balance between the mean and the variance. So if we just try to see that how it works in Excel. So this is the optimization. Problem that you're trying to solve. The first one is what you usually see. Second one is usually more easier to understand, but no problem. So we'll have a look at how it works. So what I've done here is just a simple Excel. I have simulated some price for the or some returns from some assets. So this can be some stocks, it can be any assets, it can be strategies, it can be even other portfolios for that matter. So we have assumed some stream of returns. So it's generated by some simulations. So next what you do is that we compute the covariance matrix. Now, for those of you who are not very familiar with what a covariance matrix is I suggest that you it's not very complicated. It's essentially a relationship between the variance of two time series. For exact values, you can go to Wikipedia, for example, and check out, or you can use the built-in functions. So for example, in Excel, we have this built-in function for covariance. I'm using the function called covariance.s. S stands for sample covariance. So we're computing this covariance function. And then we are assuming some weights. So let's say this is some weights where we are going to put all our investment into the asset one and the rest are zero. So if you do that, then what is our portfolio return? So our portfolio returns becomes effectively this weights multiplied by the returns of this individual asset series. So it's just some product of this weights and this return. So these returns are effectively the I've taken average. This average gives us the function average in Excel gives us the arithmetic means. Technically, I should have taken the geometric mean. So I have cheated a bit, but it's fine for the purpose that we have here. So this is our portfolio return. So we have the weighted average return of the 5 assets. The portfolio variance, on the other hand, is again it's a weighted weighted value of the covariance matrix. The way we measure is that we take a transpose versus non-transpose sandwiched and sandwich the covariance matrix in between. It gives us a scalar value. So if you're not familiar with the expression, actually you will see that expression in the presentation that we had. We can have a quick look at it. So this is what you are trying to compute here. W are the weight, sigma is the covariance matrix that we have seen, the capital sigma. And this is the portfolio variance, the small sigma, and mu is the portfolio returns that you've just seen. Now going back to the sheet, so this is what you get, and the portfolio risk is just a square root. So I scaled it. I scaled it with these are daily returns I've assumed. So I've scaled them with a annualization factor 252, which is the standard annualization factor, assuming 252 working days in a year. And the portfolio returns with that scaling become 11%, and the portfolio risk becomes 21%. Now, if you want to do an optimization problem, so one way of doing it is to vary these assets, these weights, and vary these weights and compute this portfolio return and the portfolio variance for all possible cases that you can think of. So if you do that, this is exactly what you have done there. So we have varied this asset in such a manner so that they always adds up to 1. And then we have computed the returns, and based on this same formula that you used here, and the variance, and from the variance, the risk, right? And from the risk and the returns, we've computed the Sharpe ratio. Sharpe ratio, as I explained, is just the ratio of the return versus the the risk. So if we do that, we get to see a plot like this. So all these dots here are a particular combination of different asset allocation between these 5 assets, and the dot is the portfolio and is plotted in the risk. So risk is along the x-axis and return is along the y-axis, so risk and return space. So if you see that, it gets a curve like this. So for example, if I have a risk preference for this much, so I have a choice of all this portfolio that lies on this particular line, that perpendicular line from this point upwards. But for this particular one, that is at the top of this curved area, so that gives me the maximum return, right? So this particular area is called the efficient frontier. Uh, for those of you who are very familiar, you already figured it out. So this is what we call the efficient frontier in modern portfolio theory. And the theory says that for a given risk tolerance, your portfolio should always be on the efficient frontier, which makes very trivial sense, because otherwise you get a lower returns than what you could have. So yes, of course, we agree. Now, the interesting thing is that this is about if you have only risky assets in your universe. Now, if you add something non-risky asset, that is a risk-free asset, that is the correct term, then it becomes even more interesting. So for example, what I've done is that I've assumed that the risk-free rate is 4%. And the risk for a risk-free asset is, of course, 0. So what I'm going to do is that if I change the axis and go back to starting from 0, so I'm going to plot a line from here to a line starting from 0 to this the topmost point here. So so for all the lines from any point on this area joining 0 is the slope of that line is obviously the Sharpe ratio of that line, because it's return versus the risk. So the slope of the line, or you can say the tan theta, the slope of the line, let's say for the simplicity, is the Sharpe ratio. And what you're trying to do is that you're trying to pick out the highest Sharpe ratio, which is from 0 to tangent to this particular efficient frontier. This is called the tangent portfolio, or it is a base Sharpe portfolio. So if you pick up that particular point, let's say this is here, and join a straight line to this 4, so then you can see that if you have an option to invest either in a risk-free or in a risk return, your returns will always be on that straight line. So for example, I have drawn this straight line here. So your return should always be on this straight line, because otherwise at any given point in a any given risk. So for example, even if you're on the efficient frontier, you can still do better by investing a bit more in the risk-free rate. And so this is the line that where you should always invest if you have a choice for risk-free rate. So that means if the investors are intelligent, all the portfolios for all investors will be somewhere along this line. So somewhere exactly where, that will depend on what's your risk tolerance. If you want 14%, you'll be here. If you want 10%, it will be here. But it will be somewhere in the line. And this line is known as the security market line. Now, we are just drawing it for only 5 stocks, but if you do it for all the stocks in the universe, then this efficient, the most efficient point, that is the highest Sharpe point. So that is something called a market portfolio. And then basically it becomes a choice between buying the market portfolio and buying a risk-free asset and defining the allocations. So this is what modern portfolio tells us. And actually, if you're very careful, then you might have noticed that there is a very interesting property. So we just see that what modern portfolio tells us now, that the intelligent investors will always end up between a risk-free rate and a market portfolio. What do we flip it? What do we say that given intelligent investors and market equilibrium, what this means for the market prices. And this leads us to a very interesting thing, which is a very essential tool for portfolio optimization called CAPM, the Capital Asset Pricing Model.
What exactly is this capital asset pricing model? If you could just explain that.
Yeah, sure. So if you see that one of the biggest contribution of MPT, the modern portfolio theory, what I think is it changes what is our concept of risk. So um, usually measure, as I say, that in finance we measure the risk as a standard deviation, but now since we have a choice between the market portfolio and the risk-free rate, then obviously that means for any new asset that comes in, and we have to redraw the entire chart again. What we are looking for is not the standalone standard deviation or the standalone risk of that asset. We are looking for how much that asset is going to contribute in terms of risk to the market portfolio, or as we say, the beta. So the measure of risk, that is a contribution to the market portfolio, becomes a measure of risk for an individual asset and not the standalone risk, standalone standard deviation of that. And that brings us to a CAPM through some mathematical jugglery, which we can skip. And CAPM can be captured in these two equations. The lower equation says that what is a realized return. So the realized return is something called alpha, that is the intercept, and then something called realized risk premium, which is the difference between the risk-free rate and the realized market return multiplied by the actual beta or the realized beta. And then you have some idiosyncratic risk term, which is called epsilon. And if you take the expectation on that as you know that we have to do a mean variance optimization, so you have to measure the variance and you have to estimate the mean as well. So the mean is estimated mean is essentially the expectation of this return. And if you do that, then it becomes, as you know that the market is efficient, so it assumes that you cannot have any alpha, so it basically degenerates into the risk-free rate. And then the other term becomes just the expectation on the return of the markets minus the risk-free rate. Risk-free rate is of course given, so there is no change if you take the expectation multiplied by the beta. So this is what a CAPM model is. It says that the required rate or the theoretical returns of a risky asset is the risk-free rate plus is beta, that is some kind of contribution to the market portfolio in terms of risk, multiplied by the difference in the market returns minus the risk-free return. So as we've seen that this is what is called a risk premium. So it's basically the risk premium multiplied by the beta, market risk premium multiplied by the beta, that becomes the asset risk premium. So it's essentially risk-free rate plus the asset risk premium. So this gives us a theoretical basis for what we call the value investing. So value investing is basically essentially is looking at the CAPM model or any other equivalent model and seeing that what the value can be, and then see that whether the actual traded value is very far off from there, and based on that you either buy or sell the asset. Now how you use the CAPM model, that is that varies a lot. So for example, you can use a discounted cash flow model, or you can use a comparison model, so any other model. So essentially you use the CAPM through those models to estimate the fair price, and then you figure out the opportunity. So this is what the value investing is. So you are trying to say that I am trying to, although the market says that I'm going to get risk-free premium, risk rate and the risk premium, but I'm going to capitalize on my better understanding into the alpha that you see in the realized part. So this is what the value investing is. You bet on the idiosyncratic upside and hedge the market risk.
So as you said, CAPM inspires value investing. So are we saying that this is how we should build our portfolio, or what is?
That's very interesting. So let's see. So is it really that? Um, do we really think that the idiosyncratic risk is idiosyncratic? So if you agree to this question that it is really idiosyncratic, then that's it. So you should go for value investing, and that's pretty much what you can do. But if you think that the CAPM doesn't do a great job, we can do better. That is where the factor investing comes in. So it was pioneered in 70s. It was popular. It became very popular after 2008 because of the correlation 1 event. Where everything crashed simultaneously, and there was there's no benefit of diversification, the so-called diversification. So what factor model says that hold on, it's not just the risk-free rate plus your beta into the market risk premium. It's risk-free rate plus a series of risk premium, and market is just one of the factor. So the expectation equation become very familiar to the one we have just seen, but instead of just a single risk premium multiplied by beta, we have a series, k different factors which are summed up to arrive at the expected return. And similarly, the realized equation also just mirrors the same thing. And the way we started on this is something called APT, the arbitrage pricing theorem. So that provided us a framework without specifying all these factors. So the risk premiums are the change in the factor. So without specifying what are these factors are, it gives us a framework to actually analyze this kind of expression. And then this famous paper from Farmer and French, they came up with three factors. That is, one factor is the market, and in addition, another two. And that changed. That was one of the pioneering paper in this domain, and that changed a lot. And then there was then there was some other pioneering papers on the factor investing, especially from Jagdish Tetler on the momentum investing, and later on, very recently, Pedersen and others on the time series momentum investing, and a lot of other factors. So now factor investing is pretty much established way of investing, and that says that idiosyncratic risk is not idiosyncratic. You can explain it further using different factors, and that gives us a new interpretation of what you call alpha and beta. So alpha and beta, as you see in the CAPM model, just the intercept and just the coefficient. Now we say that alpha and beta is not that. What if the delta F in the equation is time invariant and positive along with beta? So that means that your first equation, the realized return, your second term becomes a constant. So that piles up with your first term, the alpha. So together they becomes the total alpha, and this is the purest alpha you can get as an investor, where your risk factors are totally deterministic, your beta is also totally deterministic and even constant. So that is pure alpha. What if your risk premium is stable but beta varies? So this is where you know that you have a risk premium somewhere, but you don't know how much you're trying to get. It depends on the particular situation of the economy or the business cycle or whatever. So that leads us to a style of investing, a portfolio optimization called the factor allocation. So that is where you try to allocate differently among different factors and try to rebalance it from time to time. And if beta is stable and the risk premium varies, then the strategy that we are going to follow is what you call the factor timing, where we know exactly that what is the our sensitivity to a particular factor is, but we don't know what will be the change in the factor. So we are trying to predict that change by whatever means, a better model or technical analysis or quantitative analysis. So we are best trying to predict the factor change and build a portfolio. So that is factor timing. And what if everything unpredictable, then your best bet is just the alpha, the first term, and you go back to value investing, stock picking. So that means it is really idiosyncratic. The factors doesn't make sense for this particular asset.